Good afternoon, ladies and gentlemen. At the onset, may I extend a warm welcome to all participants on behalf of CII. The webinar initiative of CII is very well appreciated by our members, and we have organized over 120 online sessions since its launch in 2009. Over 5,000 members have participated, and the feedback from our member is quite encouraging. Today's webinar will deliberate on corporate governance. In recent times, rifts between several companies and their PE investors came to forefront in the media. Such incidents time and again underline the importance of good corporate governance for a company's long-term growth. Through corporate governance as a function has evolved a lot since the financial crisis. There are still a few areas where the existing framework falls short. This webinar will provide an overall overview of corporate governance and also touch upon pressing issues in the area of corporate governance. We have with us Mr. Rajiv Patra, Partner and Co-Head Governance, Risk and Compliance Services, KPMG India. Mr. Rajiv Patra is a chartered accountant by profession with over 23 years of experience, and his strengths include evaluating and strengthening corporate governance framework for organizations. He has worked with companies across diverse sectors, including consumer goods, manufacturing, retail, logistics, and infrastructure. Mr. Batra leads the firm Major Projects Advisory Practices. He has been instrumental in conceptualizing the major projects advisory services offering and is responsible for consulting with clients on major projects, rollouts, and capital projects. He is also qualified as a Certified Information Services Auditor from ISACA, USA. May I request all participants to make a note that the webinar would be a one-way communication from CII Mumbai. The live interaction session would begin after the presentation by Mr. Batra. Participants are requested to type their questions in the questions box, which would be opened during Q&A session, and Mr. Batra would take it up live one by one and would answer all the questions. May I, on behalf of participants, extend a formal welcome to Mr. Batra and invite him to take over the session. Over to you, Mr. Batra.
Thank you very much, and good afternoon all. The structure of the discussion today, as I said, it's a little one-sided discussion, but I'll try to make it. I'll pace my discussion in a manner where we'll try to cover my content of the presentation in the next 40 to 45 minutes. If it takes longer, so we'll have a room, and I'll leave the remaining time for the question and answers. I'm just going to launch the presentation, which probably will be visible to you in a short while. But as the presentation is getting onto your desktops, the one thing which I wanted to kind of quickly pick up is that the topic of corporate governance is one which, to my memory, is one of the most spoken about and written about topic. Yet the mystery of the corporate governance subject remains still a mystery and unsolved. And in my endeavor over the next 40-45 minutes and this webinar is obviously not do the unachievable of solve the mystery of corporate governance, but bring to light in the form of content as to what, in a sense, true the corporate governance means and what are in the current form of it are the typical challenges of corporate governance. So the way you, what we are going to talk about today is with regards to what are the key themes in corporate governance, and as I mentioned that most of you are familiar with the various regulations which the India government has and the regulators have instituted, is all in some form or the other address issues of corporate governance, typical challenges. We're just getting the presentation on to you. Is just, as I said, in some form or the other, Murphy laws of always hold good. but I guess you probably can see the presentation now. Slideshow. So I'm assuming you can all see the presentation now. I'm in the title slide, and I move on. So broadly, as I was talking about, the broad content in which I want to structure our discussion today will be these 4 or 5 broad topics. One, as I said, definition of corporate governance. So there are multiple definitions, and I'll try to see if I can uncover the definition in the way I see this. Where we spend the most amount of time is as part of the definition of corporate governance is to talk about what is happening across the globe in terms of addressing the issue of corporate governance. Whereafter we will move on to the issues of what are the current trends and the pressing issues, or to some extent, if I may call, unanswered questions on the corporate governance in the times of today. Moving on to identifying what are the cornerstones and the enablers of good governance, and concluding by showing examples of good case studies of corporate governance. I do also have some bad case studies, but I don't think so I want to end that with bad case studies, but leave an example with a few good corporate governance case studies of corporates in India. All of you, as I said, corporate governance, as I started by saying, dates back to, to my memory goes to Enron. While corporate governance is always been, as long as the company existed, the corporate governance existed. So it's not that the corporate governance is only dates back to the time of the Enron happening, but the fact is that Enron made the regulators think that the corporate governance as currently defined didn't need to be relooked. So the Enron happened, following which Sarbanes-Oxley and Turnbull guidance came into play for regulators to address some of the issues which they saw the corporate world was suffering and trying to address those issues. But following on those footsteps, we all recollect some years ago, SEBI also changed the guidelines of corporate governance with regards to the listed companies and listing rules, where Clause 49 was one of the formats of one of the elements of corporate governance which was introduced, where some degrees were mandatory. But despite those implementations, we did have our own Enron in form of Satyam happening a couple of years back, which actually made everyone think, and which actually leads me to kind of question what is corporate governance. This is what the definition of I would say corporate governance, because we all saw in that time that corporate governance, despite every regulation and every guidelines being provided, it still had the issues such as the Satyams and the Enrons happening. So corporate governance is not mere tick in the box, but it should be a reflective of the values and principles an organization lives for. Corporate governance, if I say, is in the minds and not in the forms in which the regulators are prescribing it. Those prescriptions are driven by those values and principles that the organization would work with, and hence corporate governance in the minds of organization will remain varying, but these regulations which our regulators are provide those boundaries, the minimal boundaries around which the corporates need to operate to protect the stakeholder interest. If I actually draw reference to Mr. Narayan Murthy, who actually defines in a very crisp form as to what the corporate governance means in his sense, and he says that corporate governance is about owners and managers operating as trustees on behalf of every shareholder. And I probably can use the word stakeholder, large or small. So effectively, as corporates, the essence of good governance is all about accountability flowing between management and the board to work together to achieve these better interests of the stakeholder. And hence, in the right form, Mr. Murthy describes board and the management as trustees of the stakeholders. So the corporate governance is all about whereby there is a flow of information, flow of reliability, and flow of data between the board and the committee, the CEO and the management, whereby the board is contributing to the strategy. Board, which is independent and combination of independent and executive members, play a role as mentors and coach the management, bring external and outside in view, and an independent view around new insights of the business, and effectively commit time to the organization. So they are not just for the sake of just coming to the audit committees or the board members, board meeting, but actually are expected to provide the value to achieve the corporate governance. And on the same side, on the role of the management, which is providing information to the board to to enable them run the business better, needs to ensure open and transparent communication, actively seek board advice and their inputs, and implement the board recommendations. So that is what I would say is a reflection of a good corporate governance operating in an organization. I'm not going to kind of talk about all of these events or scams which happened internationally, but I think the reason I brought this slide out was largely to draw a reflection that how the governments, it's not just in the shores in India, but also the regulators across the globe reacted to the corporate governance. Again, going back to the point I mentioned, that corporate governance is not something which needed to be prescribed. It is in the minds, and it is what the values, as I described earlier, with which the companies wants to operate. However, the events which happened over the period between 2006 and to as recent as 2011 and 12, where the regulators actually stood up to the idea of saying there needs to divide, and actually the regulators went on an overdrive as a result of the reaction to ensure they protect the stakeholder interest. And some of the outcomes of the events which we just flashed in the previous slide led people to believe, and regulators to believe, the need for making the boards being held more accountable. All of this led to institutional activism, which became very prominent, and there was a need for greater stakeholder or shareholder insight into institutional activism. Auditors came under the glare. Clearly, the regulators felt need for strengthening of the corporate governance regulation, and we also saw as a trend the CEO tenure was rapidly declining as a result of these events. And as I mentioned, that the regulators across the globe went into overdrive, and over the period of last 4 to 5 years have made significant number of recommendatory and actual changes to the governance rules to strengthen the corporate governance. Be it UK, where FRC worked towards strengthening the UK corporate governance code, or proposing stewardship code. Back in the US, there was one was the Sarbanes-Oxley, and then the SEC changes made to the proxy disclosure requirements. They also proposed changes to the majority voting of the directors and nomination. And closer to the homes, where we had the SEBI guidelines, clause 49, to the takeover code, to the proposed amendment bill, which is still pending in the Parliament for approval, and the corporate governance voluntary guidelines. Now, if I spend maybe just a very, and not bore you with what is happening across the globe, but just to give you a sense of the flavor as to how each and every country and the regulator in the country has actually reacted to the governance failures in the corporate world. Starting with UK, if I may, the committee under the Sir David Walker reviewed the corporate governance code in the UK banking industry and made recommendations in several areas, including effectiveness of risk management of the board level, balance of skills, and effectiveness of board practices. The Financial Reporting Council, which is the FRC, also revamped the UK corporate governance code applicable to listed companies. They revised the codes, in which the revisions which they made to the code included changes to the re-election of the chairman, entrusting additional responsibilities to the board, to the chairman of the board, emphasizing on the balance of the skill sets and the process of selection of the board members, and requiring of external independent board evaluation at least once in 3 years, and greater transparency. Some of these changes which were proposed by the FRC are also figuring out now in our company's amendment bill of 2011, which whenever it gets approved. Dodd-Frank Act was another major change which the US government took, and with specifically focusing on the financial service sector on the heels of the Lehman Brothers and the other downfalls of the banks, where the entire stated objective of the Dodd-Frank Act was to promote financial stability in the United States, for the financial stability to improve accountability and transparency in the financial systems, to ensure that it doesn't have any big falls which they experienced. And as I mentioned, on the Indian shores, what we saw, SEBI tightening the grip on the entities like mutual funds by mandating the AMCs to provide the financial statement data in a prescribed format in at least in a 6-monthly basis. As I talked about, the SEBI's takeover code was also aimed at creating a level playing field for all acquirers by fixing the open offer at 26% instead of the 100%, thus enabling easier access to the growth capital. MCA came up with the voluntary guidelines, which came out some years back, and that was a very radical change, because all the while the government and the regulators were coming with the prescriptive rules, whereas the Ministry of Corporate Affairs came up with the voluntary guidelines on the corporate governance, suggesting on a principle-based best practices in corporate governance. Ministry of Corporate Affairs has also, as I talked about earlier, made proposed amendments to the Companies Bill 11, 2011 to enable greater stakeholder democracy, stricter norms for corporate governance and corporate social responsibility, emphasis on self-regulation and greater disclosures, stricter measures for investor protection. The investor protection and the investor activism has been given some room in the Companies Amendment Bill, and stringent penalties for repeated and serious offences. I think penalty, if you ask me, as I said, there is a dichotomy or a two schools of thought to say, as I said, if corporate governance is all about how you feel in the mind, if governance is how you feel in the mind, then why do you want to prescribe rules? But at the same time, it is important that while I am personally supportive of the fact that it needs to be a principle-based definition with some outline guidelines of the minimum boundaries which need to be formed, with a strong enforcement of penalties and for non-compliances. Because to some extent, if you may recall, the SEBI's Clause 49 listing agreement requirements, the reason they were not so successfully implemented, while everyone still complies for it, and to what extent, because it continues to be ticking the box, as because of non-enforcement did not result in any significant penalties other than or enforcement of the non-compliance was not so severe. So if you look at it from a corporate governance perspective, if you look at the various changes which the government made or the regulators made to institutionalize or strengthen the corporate governance, there was 4 or 5 key themes or the key areas which they all wanted to focus, and it still remains as one of the bigger challenges for the corporate governance, and looking more specifically into the Indian corporate perspective. One of the key themes which I talked about, the first one is related party transaction, and to link to that, it actually is driven. The reason this theme is this issue is even more relevant because of the nature of the corporate world in India. Indian companies face the certain peculiar governance challenges that stems from the very nature of the Indian incorporation. Today, there are various analyses, but the analysis I refer to indicates that over close to 70% of the listed corporate of India are promoter driven. And the challenge on related party transactions and disclosure, and more importantly, the intent of the related party transaction becomes a huge concern from a governance perspective, largely from a promoter driven organization. By no means I am saying promoter driven organizations are a bad thing. In fact, on the contrary, the promoter driven model has some inherent strengths that ensure long-term growth, because promoters' own stake is in there, and hence the entrepreneurship, the long-term growth, business continuity, agility is provided. However, promoter-driven organizations do come with the unique challenges from a governance perspective, and some of those I'll try to highlight. Not completely listed on this slide, but I'm going to pick up some of the points from there. The first one of those challenges from a promoter-driven organization is the conflicting interest of family shareholders and non-family investors. while family shareholders might be too focused on long-term growth and the non-family members are too focused on short-term results. So that's where the conflict arises. The second challenge which comes from a nature of our corporate India is inadequate segregation of family and business. Quite often, especially during the early stages of the startup of the business, the company and family relationship might not be clearly distinguished. Specifically when the company and the family assets might not be legally separated as well, which again causes that issue around related party and corporate governance. Informality in the governance structure is also sometimes commonly found in such organizations, which can lead to more reliance on key people rather than the structures and processes, and thereby weak control that doesn't grow with the business. And we've seen that, at the stage where the companies are growing, and some of the promoter-driven organizations have decided to step back and professionalize or another form corporatize this organization, because sometimes the lack of the informality in the governance structure is impediment to the growth of the business. One of the other common challenges seen around the promoter-driven organization is centralized and entrepreneurial approach to decision making. While one will mock that, having somebody putting entrepreneurial approach is a challenge, but while this approach definitely facilitates creative decision making and ensures quick and timely decision, companies need a more structured, which is risk-based and risk analysis approach, and a consultative decision making process to arrive at better decisions. So in an economy where family-owned businesses dominate, the desire and opportunity is to use a known party. But the lines between using a familiar face and exploiting shareholders' resources for personal gain becomes very wide and very gray. And this is one thing where I'll talk about in the subsequent slide, how some of the prescriptions and some of the rules proposed in the company's bill are addressing these issues on related party transactions. However, it's all not that gloom. Because if I look at it, and one can always come back and challenge to say, we do have disclosure requirements on related party transactions, which our corporate world is more than effectively doing. A study which was conducted between 2002 and 6, the results of the study indicate that the Indian companies disclosed more than minimum level of related party disclosure required by the Indian accounting standards. So there is that silver lining to say there is a change in the mindset whereby companies are coming forward and sharing or segregating the personal and business interest by disclosing the related party transaction. Moving on to the second theme of what are the pressing issues in the corporate governance. Again, linked to the nature of Indian corporate, which is the promoter-driven. Promoter or large stakeholder actions are caused, promoters or the large shareholders' actions are caused due to stature mismatch in the boardroom. Due to the promoters' strong influence, their prejudices and inhibitions and values, the board culture is significantly influenced. And I'm sure some of you on the call may be able to appreciate that. If the promoter's aura is so big that the directors are overwhelmed by the promoter. And I'm not going to quote examples of this which are also in the public domain, but some of the decisions of director judgment, independent directors or the management judgment is actually overshadowed by an overarching promoter because of the manner in which he is attached to the business, not for any other intent. Hence, to serve an effective counterweight to the promoter, boards should ensure that the statures of the non-executive members are equal or greater to that of the promoters, so that in the event of the promoter's view, somebody is independent, they can rationally indicate to say, can challenge the promoter, and hence it's important that the non-executive directors, the selection of the board members and the non-executive directors, it is clearly identified that these are truly independent and of the stature who can challenge and stand up to the promoters. Because of the authority of the board vis-a-vis the promoters fluctuates, it is also recommended the term limits of the directors should also be considered. It should not have the directors for eternity, which I think our current regulations allow for that. This ensures that not only is the fresh perspective which enters into the boardroom, but that suitably qualified and distinguished individuals populate the board of all times. Now, here I draw your reference to the FRC recommendations in the UK code, where and also in a couple of other Singapore code as well, if my memory serves me right, where the regulations suggest of having a very independent transparent process of board member hiring, whereby board members are hired on a skill set basis, not for the sake of just filling the board seat, but skill set definition is also defined, and independent third party assessments are done to assess which is recommended, which is that independent assessment of board functionality is assessed at least by third parties, not from internally. Some of the other practices which are also proposed, but I do not know to what extent they've been implemented to ensure that the promoters don't overarch the corporates or the professionals, is segregating the roles of the chairman and the promoter. This is one area which kind of has been debated a number of times, and we still don't have the answer, is segregation of the roles of the chairman and the promoter, and alternatively appointing lead independent directors. And there are companies like Bharti who are following this. So this example, which was to pick up later in the slide, the companies like Bharti have appointed those lead independent directors. So, but the fact is that despite some of the such corporate governance recommendations, we still find that many firms reward the well-performing promoters and make them a chairman. The capital market regulator, which is the SEBI, has now asked the companies to furnish details of the shares pledged by promoters, which is now mandatory. So I think to some extent this recommendation is at least bringing some visibility to light. Moving on, and it's on the next slide, which is on your screens, it's very related to the previous one, which is that the another disadvantage of the family-owned business is the proximity of the promoters' family to the business. So in the earlier slide, we were talking about the promoters' proximity. Now we're talking about the nominees in the board, or the nominees in the management, or the management members, the proximity of disadvantage caused by the proximity of the promoter's family to the business. This proximity creates insiders and outsiders within the board. So you actually form two factions in the board, thus actually undermining the quality of decision making, which may not be in the best interest of the company. Hence, it's important that the nomination and the independence involved in the execution and the board is very important ingredient for effective corporate governance. The last pressing issue on the corporate governance which need to get answered is around much talked about institutional investor activism. While our Western counterparts have addressed this very effectively, be it US or UK, I think this issue is actually coming to light, and once the company's amendment bill gets passed, I think to some extent there will be some visibility around that. Let me break this topic issue into two parts. Number one, I'll first pick up shareholder meetings and voting. Although shareholder votings may seem like a straightforward activity, voting systems in our country are still very archaic and complicated. Now, from a visibility and transparency, from a shareholder meeting, I think if you look at from an AGM perspective, we still don't have sufficient information flowing to the investors to make the informed decision. Now, if you talk about one of the essential for the good corporate governance is openness and transparency, specifically to relating to the access to the meetings. Despite most companies having their dedicated investor relations section on the website, I'm sure most people on the call will agree with me. How many times have we seen an agenda for the AGM posted in that website? Similarly, most of these information, so neither are the agendas there, or neither are the subsequent activities performed or corrections are done. So detailed agendas for the annual shareholder meetings are often not accessible. The only two exceptions which I can remember are in the cases of HDFC and Infosys, who published the 2009 AGM agendas on their website. However, it's important to note that major markets around the world are archiving the meeting notices on the exchange website, and it is becoming a common practice across the globe. It allows the investors to understand the corporate actions undertaken by listed companies in the past, what governance standards are there applied in the major transactions, for example, of new fund or acquisition, who have they nominated to their board of directors, and what conduct or content of the meeting shows an improvement in governance. So that transparency, that kind of transparency is missing in the corporate India. Similarly, on the voting process, which I'm thinking again, most of you would agree, usually the voting happens to the show of hands rather than by poll. Voting by show of hand is actually disfranchises the investors, since a person at the meeting, whether they are a shareholder or a proxy for a shareholder, gets one vote per resolution, irrespective of the shareholding or the voting power. So irrespective of the shareholding, whether the shareholder or the proxy is holding 1 share or 1,000 share or 1,000,000 shares, gets one voting power to the show of hands. Investors are further marginalized because companies enforce an archive piece of English company law that says that the proxies are not permitted to speak at the meeting or vote on the show of hands. They can only vote on polls, which, as we know, is not happening. Since polls are rarely called at the AGMs in India, this means that the proxy votes of shareholders who cannot attend meetings are not counted. Hence, the 2 points on the shareholder activism I'm bringing out is, number one, the openness and transparency of shareholder meeting and minutes is not being there, and moreover, the shareholders or the main stakeholders' voice is also not being heard through the process of the voting. The second aspect on the institutional investor activism is around which, as I said, is now being considered as the class action suit. For the first time in India, the bill introduces the right for one or more members or a class of members of creditors to file the class action suit, which is one of the biggest deterrent available for against the companies which in the West. Similarly, SEBI has also recently proposed the Finance Investors Association that wish to file corrective lawsuits against the company management which have misled them. So some degree of harmonization is required between both these 2009 and the SEBI bill, but the good encouraging point is there is a recognition, the need for recognizing the stakeholder engagement and institutional investor activism as an acceptable norm of corporate governance. Looking at the 4 or 5 themes I talked about on the pressing issue on corporate governance, let me kind of summarize in what I mean are the cornerstones for effective corporate governance. Before that, this is actually a definition of good corporate governance given by Mervyn King, who was the chairman of the King's Committee report for corporate governance. And that actually is a good summarization of the presentation to the point to say good corporate governance is about intellectual honesty. In fact, the emphasis is the intellectual honesty and not just sticking to the rules and regulations. So that's what the good corporate governance is. Coming to the cornerstones of good corporate governance, need for a diverse, which is diverse means in the skills and gender and even the cultures, need for a diverse and independent board that is able to challenge the management of strategic issues. Openness and transparency in the dealings with the stakeholders. A constant effort to improve accountability. We've talked about the board accountability as well as executive accountability to drive better performance by focusing on most substantive issues. Ability of the board and the management to work together in defining the optimum business model for success, and we touched upon this topic at the beginning of the presentation. And finally, the ability for the board and the management to assess and manage emerging risks. Now, here if I spend a minute more, now would we not want to claim the financial crisis which is happening in the rest of the world to some extent, which India is also facing in some form? Is it if each and every company was looking at managing the risk or identifying the risk and at least understanding which risk can be managed or mitigated, some of these crises which a corporate world is facing could have been mitigated or managed. The whole point, which is an emphasis, is that it's no point looking at risks which which you're anyway working on. It's all about looking forward to those emerging risks which could cause emerging issues which could be the major risk to your business. Coming on to the next section and almost towards the end of my presentation is to talking about what are the enablers of good corporate governance. Now, if a company chooses to adopt that good governance, I would want to classify them into three broad buckets: is building an effective and ethical ecosystem, embedding control consciousness within the organization, and establishing a continuous monitoring to address the various business stakeholder needs. I think the core of a good corporate governance is establishing an ethical ecosystem, which is what I talk about intellectual honesty. And the three cornerstones for that intellectual honesty or cornerstones for establishing an ethical ecosystem is having philosophies, people, and processes. Now, the corporates and the boards which value setting the tone at the top, they are the ones from a philosophy perspective define what the governance structure should be all about. Talk about the leadership value system and also establishes the code of conduct applicable for the board as well as the management. The effective ethical ecosystem can also be established in form of processes through well-defined policies and procedures, control environment, and well-enabled an IT system and IT control system. And the people which contribute to the ecosystem would mean periodic training and recruitment, making them aware of the code of ethics and performance management and delegation. So these are the three cornerstones of the effective and ethical ecosystem. This is a case study example whereby what we are trying to bring out is a company like Unilever back in our country. There they use internal auditors and the risk team to actually validate the effectiveness of the code of conduct and audit areas to validate if that breach of code of conduct or breach of ethical system or identify areas where there is a suspect breach of code or ethics is verified. From a control consciousness perspective, what we're saying is that the control, you don't need an audit to come and tell you what the controls you're missing, but there's a need for embedding the control self-assessment or the control consciousness within the organization. While policies and procedures will provide the baseline or underline for the control, but it is important that the control consciousness is embedded within the organization. And finally, I picked up four stakeholders four business stakeholders, including CFO, the head of audit, the chief information and compliance officer, outlining as what are the specific continuous monitoring processes they need to do to be able to ensure that the effective corporate governance is implemented in the organization. For example, from a CFO's perspective, having a process whereby they are obtaining measures of risk and performance, they have continuous risk assessment being undertaken, and even looking at that continuous fraud assessment being done in the organization. Similarly, from a CIO's perspective, Chief Information Officer perspective, looking at system performance, looking at access controls, looking at security, privacy, and technology leveraging, all driving towards and business and corporate governance controls in an organization. Which actually now takes me to a logical point where I'll share with you some 5 or 6 case studies where talks about the Indian corporates and what are the good practices some of the Indian corporates have adopted from a corporate governance perspective. Taking the first one is HDFC Bank. The HDFC Bank board comprises of large proportion of non-exec directors who have rich functional and vertical experience. So hence, they bring the diversity of functional and outside-in view, thus adding value and independence to the board. Bharti, which I talked about, they have appointed a lead independent director, and the independent directors meet separately outside board meetings and challenge the decisions that are not in line with long-term stakeholder interest. So that's the kind of discussions the Bharti has. The Lend-Lease, where the board structure and meetings have been formalized, where separate business boards for individual business. Each of the business boards have several non-exec directors from the main board. Board of all committee meetings are scheduled in the same week, and one board meeting is held overseas with a range of guests, including middle management, customers, outside speakers. Now, while this is one good practice, but if I share a couple of others over here, while it is important, one point saying that if you have a large conglomerate where multiple companies, then having non-exec members present in multiple board makes sense. There's another good practice whereby companies of the subsidiary companies are actually sharing the minutes of the board and the audit committee and the subcommittee meeting to the primary board meetings. So those are also exchanged. It is also commonly seen that more and more boards are now wanting to have at least once a 6 months independent meeting with the senior and the middle management and customers also. So the last bullet on this in the Lend-Lease companies also coming out as a practice which boards are for adopting in many of the companies. Dabur. Now Dabur has an established ERM framework which is subject to periodic reviews by the board. In addition, the company has a CRO, Chief Risk Officer, for overall risk governance who reports to the committee of functional heads. Mahindra has a robust and centralized internal audit team, and it utilizes a web-based portal on real-time financial, which shares the real-time financial and operational information of the company and its activity equitably to all the stakeholders. The director induction practices in ICI is a formal induction process customized to individual director need, and it begins with a series of meetings with the functional heads. It involves visits to the production site, so this is where the board members are actually spending time in understanding the business, and covers the topics such as fiduciary duties, board management, risk management regulations. So these were the 5 or 6 examples which I picked up were the good practices. All the other remaining two slides are the examples of failures, which I don't think so. It's an unknown thing because we have spoken about this and the media and everyone else has spoken about it. So I think I probably would not touch upon the failure, which I think we all know. But at this point in time, actually open the floor to Q&A, and I'll make an effort to answer the questions to the best of my abilities. So our lines are open now, so you may type your question, and I'll read out the question for the benefit of the other listeners and make an attempt to answer them. We still don't have any questions. I assume we'll give you guys, obviously, that I can take as a compliment that I was overly clear in my objective, but I don't want to do that because I know corporate governance is a complex topic and much talked about issue, and I don't think so I am an expert in that, but I'm making an effort to be able to uncover some of the mysteries. In fact, as we wait for people to put in the question, the question is, from an Indian political scenario, it is more about governance, which is needed. Be it political governance or a corporate governance. And governance is all about is what the country needs to grow. So we have a question coming in from Parmeet Ghosh. I'm just waiting for the question to flow in fully. The question is, in order for the corporate governance to do well, is it required that people themselves are aware? Is something more to this question, Parmeet, if you can confirm, or is okay, the questions are coming through. Okay, I think the question is complete. Let me read the question and make an effort to answer it. In order for the corporate governance to do well, it is required that the people themselves are aware and internalize the beliefs of the organization. How far are we on this as a nation? It's a good question, and I think I attempted to answer that earlier in my presentation. It's a intellectual honesty, as was defined by one of the by Marvin King, and the fact is, it's all about the belief within the organization. So corporate governance, as I said, that's my personal view. You cannot prescribe governance. You cannot prescribe somebody to be honest. Governance is all about believing and being honest and true and transparent to the transactions you do. And you're very, very right by saying it has to be internalized, and each and every individual or each and every employee of the company needs to be believed in the corporate governance and the spirit of corporate governance to make it successful. Now, the second part of the question saying, how far are we this on the nation? If you read if I probably am not qualified to answer it for the nation, but looking at what the country is going through over the last 1.5 years and the various scams which keep hitting the newspapers, and one which is recently 2 days back on the irrigation scam, I don't think so. That clearly indicates that there is a need to strengthen the political governance, shake up the governance, but it's a set of people who make them difference. So that is not a reflection, but yes, nation needs to relook at the political governance as a whole. But obviously, at the end of it, is the individuals. That doesn't mean each and every individual is in the same boat. But as a country, I think we need a revamp on the political governance. We can take some more questions. We have time. Let me probably to engage with you and seek some more comments rather than question. Do we believe that in order as corporates in India, there's a question which has come from Preeti Lata. I'll just answer that after completing what I just started saying. That do we still believe that the corporates in India are truly, in the sense, the question which has always been asked, is corporate governance adding stakeholder value? One question where there are research given, some quantified and unquantifiable, but one thing which is common theme which appears across all companies who are aware and conscious about good corporate governance are eventually benefactors in terms of being able to solicit or attract larger capital when they go to public, or are more profitable in the way they do business. So corporate governance has a direct bearing and linkage to the bottom line. Now I'll attempt the question which Ms. Preeti Lata has given. Why companies are not following SEBI guidelines after so much penalties? They are violating corporate governance, not that much friendly for customers. For example, telecom. I do not know if I'm able to understand, Preeti, your question. Let me answer the first question, which I understand. Why are the companies not following the SEBI guidelines? As I talked about it, companies are not following SEBI guidelines because what today SEBI asks is a declaration of compliance to the SEBI guidelines in an annual report and in the quarterly statement. There is little SEBI has done, and because probably the lack of ability and the manpower, where they've actually gone back to the companies and performed independent validation of those CFO certifications. One certificate, the two things which are important elements of SEBI guidelines is they have an independent risk management which is reviewed by the board, plus the board composition, and they also look at a CFO certification of the effectiveness and internal control. How many times have the SEBI gone back into the companies and challenged? So today, companies, because they know they do not file these two important requirements, they may get delisted. In the want of that, they are doing a back-to-back assurance. So CFO gets a back-to-back assurance of control compliance from all the function heads, and then that back-to-back certificate issues another certificate. But is that adequate? How does the CFO or give the assurance to the shareholders that the internal controls are effective? Not on the basis that I don't think so. It's good basis of the just a back-to-back certificate. So the reason it has not been successful and remains a tick in the box is because enforcement and review, independent review by SEBI or any other authority to ensure compliance to the guidelines is not being institutionalized, which happens in for example Sarbanes-Oxley. There they have independent regulators looking at the performance. If you may want to write the second part again, because I am not able to understand the second question in specific to the telecom sector, Preeti. I think that's a very good question coming in from Santosh Raghavendra. The question is there a direct correlation between corporate governance and corporate social responsibility, and how do they complement each other? I think my one answer to that question is absolutely yes. The corporate social responsibility is, if you look at it from a social responsibility perspective and from a governance perspective, even if I look at it from a social responsibility perspective, and most guidelines talk about three elements of social responsibility. One, it talks about environment. Second, it talks about social, which is what the social responsibility, and third is governance. A good governance would mean you are, the communities around the corporate, and if I answer the question specifically social responsibility, the communities and around the corporates and the public at large, the organization's performance of the role of giving back to the community or working for the community itself is driving towards achieving good corporate governance. So there is a direct correlation between corporate governance and CSR, which is why again, not to the best of my personal belief that mandating a 2% CSR for mandate which SEBI has now come up with is really required, because companies should undertake CSR or social responsibility activity in the spirit of doing it, not because it has been mandated to do it. We can have some more questions. What should we put on 5? Sorry. So what we'll do is we'll wait for another couple of minutes because I don't see too many more questions coming through. It's about 3:25. So for another 2-3 minutes, we'll keep it open, and if the questions come, I will answer them, and otherwise, I will announce when we were closing the session. So I've got Preeti responding back to her telecom question. Let me just read, and I'll read it aloud. Okay, for the benefit of everyone, I'm going to read the statement which Preeti has written. Telecom industries are cheating their customers. For example, sometimes I have not applied for the service. Then also mobile operators cut that charge, and they are to say that you have applied for the service. It might look very small portion, but when you accumulate such problems may increase a lot amount. Why are we not behaving ethical in this respect? Preeti, I can completely understand where you're coming from. Uh, the point being said by you is reflection of a combination of poor governance and control within the organization. Yes, an example like this is a small element of a larger corporate governance issue. However, one of the leading questions which has just come through, a good quality. In fact, we talked about when I talked about in the earlier part of the presentation that the components of enforcing corporate governance is a good control mechanism. The absence of good control mechanism which prevents this. Now, I am not doubting the intent behind the charge, but this is actually a lack of control because there is for telecom industries there are checks and balances available are assigned in the process which prevents such misuse or incorrect charges being done. Obviously, if somebody's done it intentfully, then obviously that's a breach of corporate governance. But you're right that any company overcharging a customer or for services or for any other reason, intentfully or unintentfully, is a reflection of a poor definition of control design in the company, which in some form is an element of which builds up to an effective good corporate governance. Another question which has come from Santosh is, with corporate governance, does the scope of internal auditor become wider? My answer is as follows, Santosh. It was always the scope of the internal auditor to provide that assurance that the company's governance procedures are adequate to mitigate the risks. If an internal auditor was not covering that, then they were not fulfilling their role. Corporate governance has not enhanced the internal auditor role because internal auditor is, as I call, they are not the owner of the control, but they are the ones who are independent of the organization and providing the assurance to the management and the board that the governance structure is currently institutionalized in the organization in form of policy, procedures, codes, controls is effectively implemented in terms of effectively designed and implemented, and hence it was always the role of internal auditor to provide the assurance of a corporate governance to the stakeholders. And if an auditor was not doing it, they were not fulfilling that role. So I guess we probably we've reached a 3:30 mark, ahead by half an hour, but I will probably close the session now, and I'll hand it over to my colleague from CII to to take it over.
Thank you, Mr. Batra, on behalf of CII and participants for such an interactive session. Participants, please note the presentation and the recorded link of this webinar could be uploaded on MyCII shortly.